Welcome back. If you have a home equity loan or line of credit, we have important information to share this morning. Our good financial friend, Bryan, she's back with us with what we need to know. It's great to see you again, JB.
It's good to be here, and I love this topic.
This is an important one to cover, and it is kind of changing a little bit because of the interest rate stuff that's going on.
And that is very timely, because we know that at the end of 2015, the federal government started actually being as direct as possible, saying that we're going to increase interest rates. So for people with home equity that they're considering taking out, and basically that's when you have paid down your loan on your home, so you have cash available, some value is there, or your house value has gone up. Now, a lot of people aren't seeing that, where they're getting the equity from the value of the home going up, but people are aggressively paying down their debts now. So there's some equity available in their home. And the question is, how do I access that equity? What's the best way to access that equity? And there's really two options. You could do a home equity line of credit, which is called a HELOC, or you could do just a basic home equity loan.
Why would you choose one or the other?
And that's really what, there's a major reason, and there's a really good reason why not to do. That's a very great question. The reason you would choose a home equity line of credit, why you would do the HELOC, is because it's for a short-term need. It's for, you're not quite sure how much you're going to need, and you may just want to have access to it, but not I don't need $25,000 at one time, but you want to have access to it. So the HELOCs, they come with a debit card sometimes, or they'll come with a checkbook, and you just write for the money as you need it, and you're paying interest payments on that loan. For a home equity line, that's for a person, like you mentioned, a home improvement, and building a new kitchen, and you have a fixed need. And how would you access the cash for that? Well, then, and you also have an interest rate that is locked in on a home equity loan. But with the HELOC, it is a variable interest rate. So the lender can adjust your interest rate that you're paying. It may be every 90 days, it may be every 6 months, it may be once a year. So on a HELOC, you have to be very particular and make sure that you look at the fine print. And I have watched some advertisements on them over the weekend, because when you start thinking about something, the ads draw your attention.
You see it all over the place.
And the HELOCs are marketed as if they're not a mortgage on your home. They're marketed to you as if they're a credit card, or there's something different. But what you need to make sure everyone at home know, that a home equity line of credit is still a second mortgage on your home. So if you don't make that payment, they can take your home.
Your home was the collateral.
Yes. So it is indeed, even though it came with a credit card, it is not a credit card. It is a loan that has a collateral, and that collateral is your home.
And with the home equity loan, there's a portion of that that's tax deductible?
True. The interest is tax deductible. So on both of them, you do have that as a benefit, and that will encourage you to take advantage of it. But what we need to realize is that don't consider, and a lot of people are doing this, don't refinance your credit cards with a home equity of any form, because a credit card does not have any collateral backing it. So the interest rate is higher, but credit cards are supposed to be for short-term needs. A home equity loan is for a long-term need. That's why the payments are extended over a long period of time.
We have less than a minute,
right.
But right now, if we're in January, is the picture different at this time of year than it's going to be at the end of this year in getting that loan, and in terms of taking advantage of a better rate now versus later?
If I had to choose today between which type, I would lock in. I would lock in on a regular home equity loan, because the lenders have to assume that the government's going to do what they said, that they're going to gradually increase interest rates. They may not increase interest rates anymore, but they still have to assume that. So you're going to see adjustments on the adjustable interest rate loans that you have.
Don't forget, Ms. Bryan offers free money seminars every Wednesday at noon at her office in Glen Allen. Registration is required. For a link to more information, you can visit our show website at WTVR.com.